Hi, I'm Audie. Welcome back to the channel. Today, we are looking at the yen carry trade. We are going to explain simply why a weak Japanese yen is currently making Wall Street very nervous. Right now, we are witnessing the strange yen paradox. The yen remains extremely weak, trading around the 161 to 162 range. Beginners usually assume that this weakness is the main problem. However, Wall Street isn't terrified of a weak yen. Instead, they are terrified of a short squeeze, a sudden, violent spike in the yen's value. To understand why Wall Street is worried, we need to examine how the carry trade engine works. First, investors borrow yen because the interest rate is incredibly low, sitting near 1%. Next, investors convert that yen to US dollars and buy high-yielding assets like US bonds and tech stocks. Finally, investors profit by keeping the massive difference in returns, and as long as the yen stays weak, it feels like free money. This machine is fueled by a massive rate gap between countries. The Bank of Japan (BOJ) rates hover near 1%, making it extremely cheap to borrow. Meanwhile, U.S. Federal Reserve rates are high, sitting in the 3.5% to 3.75% range, providing a high reward for holding assets. Former BOJ policymaker Sayuri Shidai notes that this massive gap keeps the carry trade incentive incredibly strong, pushing the yen toward the danger zone. A weak yen creates a massive ripple effect with clear winners and losers. The winners include Japanese exporters like Toyota and Sony, who can sell their goods cheaper abroad, boosting their profits. On the other hand, losers include Japanese households because importing energy and basic food becomes painfully expensive. Global competitors also struggle as foreign manufacturers cannot match Japan's artificially cheap prices. Meanwhile, U.S. risk assets are heavily fueled by a massive pipeline of this cheap, borrowed yen liquidity. Because of this dynamic, the Bank of Japan is trapped on a tightrope. The BOJ wants to raise rates to save the yen from collapsing and crushing households. However, to protect the bond market, they know that if they tighten too fast, they will destroy the Japanese government bond (JGB) market. The dilemma is that the BOJ is moving hawkish and gradually reducing bond purchases. But they are trapped. They cannot raise rates aggressively without destabilizing their own bond market. For Wall Street, speed is the real enemy here. Old thinking dictated that the 160 mark was a hard red line. But new thinking argues that the exact level matters much less than the speed and disorderliness of the market. The Ministry of Finance suggests that a rapid, disorderly spike past 163 is the primary catalyst for sudden, aggressive government intervention. If that happens, we enter a nightmare scenario known as a deleveraging domino effect. It begins when intervention or a BOJ surprise causes a sudden surge or quick spike in the yen. This leads to panic repayment, where traders are suddenly forced to quickly buy back yen to cover their massive debts. To get cash, traders are then forced to aggressively sell off their U.S. risk assets. Ultimately, this forced selling triggers a massive global unwind, crashing risk assets across the board and creating intense global volatility. There is a perfect storm dashboard consisting of 4 triggers that could launch this crash. For the currency dial, danger arises if USD/JPY moves quickly into the 163-165 danger zone. On the policy front, risk increases if the BOJ sends a surprisingly hawkish signal by raising rates faster than expected. From a macro perspective, weak U.S. CPI or labor data could suddenly sink the U.S. dollar. Finally, for the broader market, trouble brews if the VIX fear gauge rises while tech stocks simultaneously sell off. Warning: if these 4 dials flash red at the exact same time, it stops being a normal currency event and turns into a massive global deleveraging crash. So, what is at risk in our portfolio heat map? High-risk, liquidity-sensitive assets will be the first to get hit, facing immediate sell-offs. This includes QQQ, semiconductors, high-beta growth stocks, crypto, and emerging markets. Meanwhile, U.S. long-term treasuries sit in the uncertain outer zone. Japan might sell them to fund their intervention, pushing yields up, or panicked investors might buy them as a safe haven, pushing yields down. Here is how you can successfully navigate the yen danger zone. First, acknowledge the trend. The base trend is still a weak yen, so don't panic sell everything immediately. Second, don't chase late. Arriving late to the short yen party right now is incredibly dangerous due to rising gap risk. Third, watch core indicators by keeping a close eye on USD JPY levels, Japanese 10-year JGB yields, the VIX, and the DXY. Lastly, use limited risk structures to protect your downside using put spreads or small VIX call hedges around BOJ meetings and US jobs data. Thanks for watching! Investing and options trading involve significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.